12 questions and answered about investment. Welcome to Business Motif channel. We gladly to provide you all about business idea, not only tips, but also example, so you can easily understand and apply the business concept that we share. Before continue, don't forget to subscribe this channel, so we can provide you more easy tips to start or growth your business. Here are 12 questions people often ask about investing and their answers. We also provide examples so you can understand better. Question number 1. What is investment? Investment is the act of allocating resources, such as money or time, to a venture with the expectation of generating a return or profit. Investors allocate their resources to different investment options such as stocks, bonds, real estate, commodities, mutual funds, and exchange-traded funds, ETFs. An example of an investment would be investing money in a startup company with the expectation of a high return on investment if the company becomes successful. Question number 2. What are the different types of investments? There are different types of investments, each with its own unique characteristics and risks. Stocks represent ownership in a company and provide the potential for capital gains and dividends. Bonds represent a loan to a company or government and offer regular interest payments. Real estate offers the potential for rental income and capital appreciation. Commodities are physical assets, such as gold or oil, that can be bought and sold for profit. Mutual funds and ETFs offer diversification and professional management of a portfolio. An example of a type of investment would be buying stocks in a company such as Apple or Amazon, purchasing a rental property, or investing in a mutual fund such as the Vanguard Total Stock Market Index Fund. Question number 3. Why do people invest? People invest for different reasons, such as generating a return on their money, increasing their wealth, preparing for retirement, or achieving other financial goals. Some investors are looking for long-term growth, while others are more interested in generating income. An example of a reason for investing would be saving money for retirement through a 401k or IRA, or investing in a college fund for a child's future education. Question number 4. What are the risks associated with investments? All investments carry some level of risk. The risks associated with investments can include market risk, inflation risk, credit risk, liquidity risk, and geopolitical risk. Investors must be aware of these risks and diversify their portfolio to manage them. An example of a risk associated with investment would be the possibility of losing money in a stock market crash or inflation reducing the value of investments over time. Question number 5. What is diversification? Diversification is the practice of spreading your investments across multiple asset classes, sectors, and regions to reduce risk. By diversifying your portfolio, you can reduce the impact of market volatility on your investments. An example of diversification would be investing in a mix of stocks, bonds, and real estate to reduce risk and improve the likelihood of long-term financial success. Question number 6. What is asset allocation? Asset allocation is the process of determining the optimal mix of assets, such as stocks, bonds, and cash, to achieve your investment goals while minimizing risk. Asset allocation is based on your investment time horizon, risk tolerance, and financial goals. An example of asset allocation would be determining the percentage of a portfolio to allocate to stocks, bonds, and cash based on an individual's age, risk tolerance, and financial goals. Question number 7. Stocks. A stock, or share, represents ownership in a company. When you buy a stock, you become a shareholder in the company and can benefit from capital gains and dividends. The value of a stock can fluctuate based on market conditions, company performance, and other factors. An example of a stock investment would be buying shares of Amazon or Apple with the expectation of capital appreciation and dividend income. Question number 8. Bonds. A bond represents a loan to a company or government. When you buy a bond, you are lending money to the issuer and receiving interest payments in return. Bonds are considered less risky than stocks, but they also offer lower potential returns. An example of a bond investment would be purchasing U.S. Treasury bonds with the expectation of regular interest payments and a return of principal at maturity. Question number 9. Mutual funds. A mutual fund is a type of investment that pools money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other assets. Mutual funds offer professional management and diversification, but they also charge fees and expenses. An example of a mutual fund investment would be investing in the Fidelity 500 Index Fund, which tracks the performance of the S&P 500 Index to achieve. Question number 10. ETFs. An ETF, or exchange-traded fund, is a type of investment that tracks the performance of a specific index or asset class. ETFs can be bought and sold like stocks and offer diversification, low costs, and tax efficiency. An example of an ETF investment would be purchasing shares of the Vanguard Total Stock Market ETF, which tracks the performance of the U.S. stock market to achieve diversification and low costs. Question number 11. What is a financial advisor? A financial advisor is a professional who provides advice on investments, retirement planning, and other financial matters. They can help you develop a personalized investment strategy and manage your portfolio. Financial advisors may charge fees or receive commissions based on the investments they recommend. An example of a financial advisor would be a certified financial planner, CFP, who provides investment advice and financial planning services to help an individual achieve their financial goals. Question number 12. What is the difference between active and passive investing? Active investing involves buying and selling individual stocks or other securities in an attempt to outperform the market. Passive investing involves buying a diversified portfolio of stocks or other securities that track the performance of a specific index or asset class. Passive investing is generally considered less risky and less expensive than active investing. An example of active investing would be buying and selling individual stocks based on market trends and personal research, while an example of passive investing would be investing in a low-cost index fund that tracks the performance of a specific market index. As a conclusion, investment is the act of allocating resources with the expectation of generating a return or profit. There are different types of investments, each with its own unique characteristics and risks. Investors should be aware of the risks associated with investments and diversify their portfolio to manage them. Asset allocation and diversification are important strategies for achieving financial goals while minimizing risk. Stocks, bonds, mutual funds, ETFs, and real estate are all examples of investment options. Financial advisors can provide personalized investment advice and help manage portfolios. Passive investing, which involves buying a diversified portfolio of securities that track a specific index or asset class, is generally considered less risky and less expensive than active investing. Ultimately, the key to successful investing is having a well-defined investment strategy, being patient, and staying disciplined. Thank you for watching our video. If you want to get more tips about business idea and tips, just subscribe our channel. If you have a question or request, let us know in comment column below. See you in the next great video.